Good morning. A very warm welcome to all of you. I'm Alessandro Sanos, the Global Director for the Commodities Sales Strategy and Execution at Refinitiv. It is my pleasure to welcome you to this virtual event organized by the CTA, the Alumni Association of the Master and Diploma in Commodity Trading of the University of Geneva. Today is the third session of this series on sustainability in the commodities market. We started with sustainable financing, then we discussed about sustainability-driven innovations, and today we will be closing the series with climate risk. But before we start, allow me to quickly present you today's speakers. Elsa Pernot is the Global Head of Sustainability for Gunvor Group. She oversees the corporate policy relating to health, safety, environment, community, and human rights. Primary to her current objectives is the implementation of the UNGP on business and human rights, as well as promoting initiatives relating to the energy transition. Elsa is an engineer and started her career as a consultant, supporting large companies on greenhouse gas emissions management, sustainability strategy, and corporate culture programs. Justin Archer has been in senior management positions in the coffee industry for 25 years, mostly for trading houses operating in Africa. He is currently the global head of sustainability for Sucafina, the Swiss-based trading company with operations in over 20 countries. He has an MSc in agricultural economics and an MBA from the BI Business School in Oslo, and he's joining us today from Kampala in Uganda. Last, by no means least, Oliver Heathman from Roskill. Oliver is in charge of the Sustainability and Cost Division, which undertakes detailed supply chain analysis on the raw materials essentials for steel alloys, batteries, and electric vehicles. And Oliver began his career in the metals and mining market and was a founding member of Metal Focus. So without further ado, let's now dive into sustainability and climate risk in the commodities industry. And I would like to start from energy. So Elsa, I will ask you the first question, if that's okay. Where does a commodity trader bring value in the energy transition endeavor?
Thank you, Alessandro. Good morning, everyone. So it is clear that today we're at crossroads. We start a new decade, we see new technologies coming in, we see a political will, certainly from the European Union, America right now, China has more and more been vocal on the matter as well. Different actors will have to play different roles in this energy transition if we want to see it happen. And the technologies we have as possible solutions for the future need a lot of work still. What I can see as a clear role for an energy trader is to help commoditize those new technologies down the line. There is still some time before we can do that. But, we talk about hydrogen islands, hydrogen valleys, and those need to become oceans at some point, right? So they need to be spread out, transported, being available everywhere, and traders will help spreading those technologies around, same with ammonia, same with solutions for shipping. And meanwhile, before this is available at a large scale, energy traders need to learn how to handle this and to be part of the discussion with all the different actors in the public sector, in the private sector, to help develop those new ways of distributing energy. It's really important that they are part of the discussion groups all around the different continents where the approaches are different. We see the taxonomy in the European Union, we see new policies coming up in the United States, and trading companies need to be involved to help on the distribution of those new technologies going forward.
Thank you, Elsa. And let's move on to the agricultural side of the commodities industry. And looking at coffee, Justin, what role does a trading company play in addressing sustainability and climate risk?
Yeah, thank you for the question, Alessandro, and greetings, everybody. Nice to meet you all. Yeah, let me first perhaps start by defining a bit what role we play as an organization in the agricultural value chain as a trader. I guess fundamentally, we are the ones that link the producers in producing countries with consuming markets. And in this case, if we talk of coffee, of course, our consumers are roasters. So we're a B2B operator in that sense. And as a trading company, our primary role, of course, is financing the crops that are produced in producing countries, providing expertise on logistics, so whether warehousing or international shipping of goods, and of course market risk management, which is a big part of what we do. So I think that's kind of where we start from. The role of the trader, I think, in many agricultural value chains, and it's certainly the case in coffee, has evolved tremendously in the last 20 years. And I've been part of that journey because, as Alessandro said, I've been in this business for quite a number of years now. But when I started my career, we looked at suppliers as merely just suppliers. We didn't recognize them as being an important player in the value chain, as it were. And I think today, with this kind of transition we've been through in the last 20 years or so, any responsible agricultural trading company recognizes that farmers are a key part of the value chain. In fact, today I'd say it's not a stretch to say that we consider farmers to be as important clients to our value chain as indeed are the roasters themselves. So there's been a complete transition, and of course this has been driven largely by consumer demand for more traceability, more transparency in how goods are produced, and of course it's meant a real transformation for businesses too. So just to take an example from our group, Sucafina, we can identify about 175,000 farmers in our value chain today. Every single one of those farmers receives some kind of support from us on a continuous basis, which means that a company like ours today has more agronomists than we have traders in the company. We have probably more resources devolved in terms of footprint on the ground. We have more resources devoted to farms and farm management than any other part of the business. And so this makes us, of course, a very important player in this discussion of climate change, because we really do harness pretty large networks of farmers around the world, tens of thousands of hectares of land potentially that are parts of the value chain. And so as that sort of direct interface with the farmer, I think consumers and consumer brands depend heavily on traders like ourselves to transmit the message of environmentalism and of course help farmers adapt to changing needs and incorporate best practices that will enable us to meet climate goals long term. So I hope I'll get a chance to speak more about that in a few minutes' time.
And I think that this best practice flow within the different farmers is something that I believe is very, very important. And probably is kind of similar in the metals business. So Oliver, coming on to you and moving on to metals, what are the sustainability concerns and environmental impacts that the predicted growth in demand from battery raw materials will bring? So moving on to the mining side.
Yeah. So thank you, Alessandro, and to the CTA for putting this event on. At Roskill, in our research, you spend a lot of time looking at the flow of material through the battery supply chain, from the mining of ores through to the production of batteries and the installation of those batteries into electric vehicles and other energy storage applications. And a lot of what my team does is look at the ESG concerns around those supply chains, and particularly the mining and the refining process of those raw materials. Now, our expectation is for EV sales to boom over the coming decade, and that's probably no surprise to anyone. And by 2030, to give you some context, our expectation is that around 50% of all passenger vehicles sold globally will be either fully electric or have some form of hybridization. So to power these cars really will require a lot of batteries, and to fuel those batteries really will require a significant increase in a number of raw materials production, particularly lithium and nickel. So just for context, we're expecting or we foresee that nickel supply is going to have to nearly double over the next 10 years, while lithium really needs a sort of a whopping 6-fold increase in supply to sort of fuel these batteries. But with the growth in these supply of metals will bring sort of significant environmental cost. and with that, sort of looking at lithium, it's an interesting one, and it's very polarized. So lithium comes from two sources. Traditionally, you have the brine assets dominated by the salt lakes of South America. And then you have what we call the hard rock sectors, and these are more traditional mined sources of lithium. So for the brine producers, you can see that in many instances they can use solar evaporation to concentrate that lithium. So a lot of the work there is done by the sun. So they have relatively a lot lower CO2 intensity. In comparison to the hard rock supplies, you're mining or you're crushing it, you're concentrating it. And then in many cases, you're having to transport this material to China for further refining in an environment where there's quite a lot of coal use either on these plants or within the local grid mix. So from the hard rock sector, you see a significantly higher CO2 intensity. And then as supply grows, you're going to see that CO2 output grow considerably. The other one, looking at nickel, on a per ton of contained metal basis, the CO2 intensity of nickel is lower than lithium, but that's largely counteracted by the significantly higher volumes of nickel in many of the battery chemistries. So within nickel, the issues are also CO2 related, but also there's quite a heavy environmental burden there. A significant portion of nickel comes from what we call laterite deposits. And by their nature, these are in tropical regions, and their sort of mining requires the removal of large amounts of vegetation, which is often rainforest. Furthermore, the disposal of these, the waste from these processes is a point of contention and can be quite difficult on land. So many of the sort of actors looking at developing these projects in Indonesia and other places in Southeast Asia are looking at what we call deep sea tailings disposal, which is effectively dumping the waste off the continental shelf and into the deep ocean. And that obviously brings with it huge environmental concerns. But around this, I think just the final point to note is that as supply grows within these sectors, that the fact that you can build sustainability into the core of these projects is a real sort of positive and something that I think is more and more focus of these companies.
Thank you, Oliver. And I think that some of the points probably we will be touched upon them in the later questions. But there is a question that I would like to ask to the three panelists. This is a topic that I find extremely interesting. It probably is an area where until now there wasn't a lot of attention, and it's about stranded assets. Basically, those assets that suffer from anticipated or premature write-downs due to environmental challenges, new regulations, or even the evolving social norms that were cited earlier from the speakers. So what impact do you see from your respective market? Probably let's start with Elsa, where we had in the energy market already several dozens of billions of write-downs.
Yes, I think we can see different types of assets and how it has been treated by the changes in expectations, norms. I think we see the really upstream assets where we actually extract and produce the energy. We think, of course, of coal being more and more blacklisted from certainly public expectations, and then more and more into hard law, where it becomes difficult to deploy processes involving coal. So those we can see clearly that the future is going to be difficult. We can see other types of upstream asset producing assets, etc., where there is some opportunities to transform the way we produce the energy. We can see it with oil, we can see it with gas. We have seen companies really committing to enhancing the way they produce the energy, getting to electrification of offshore platform, getting to real improvement in the liquefaction of gas, etc., etc. So there is a risk of stranded asset. There are also opportunities to completely change the way the energy is produced. And we have seen previously in the North Sea, for example, we have seen some assets that were said to be stranded because it was too expensive to produce the oil. And we have seen smaller companies coming in and being able to continue producing this oil, being more effective in their operations. And I think that there's a real opportunity to be less carbon intensive in the way we produce the to make sure that those assets are still available, because energy will be needed in the future.
Thank you, Elsa. And Justin, Oliver, what would be your view in your respective market?
Well, I can jump in quickly on the agri side, and I have to say it is a less relevant conversation because, of course, the main asset in production here is the land. And of course, yes, land is a valuable asset, and definitely the modeling shows that climate change is going to take some coffee lands out of viable production in the next decades or so. But it is a slow transition, of course, right? So I guess the reality is farmers have time to adjust, perhaps plant crops that are more adapted to a changing climate. That being said, of course, a business like ours is very integrated in the supply chain. We have facilities right upstream to the sort of farm gate. Could be small processing facilities. And here we definitely feel the pressure and the tension of a less sustainable, less viable supply chain, because as we see productivity declining, which we do observe in some parts of the world, it's clear that some of the farmer suppliers to our business are struggling to maintain the same levels of productivity, right? So this puts a question mark around the viability of those assets. Of course, we don't talk about the same multi-billion-dollar sunken costs that we see in energy and minerals, of course, but it is a concern. So I think what you see in companies like ours is increasingly looking at systems of production that are more adapted to climate change, helping farmers stay on the land and produce coffee in a viable way for longer. Remodeling the way coffee is farmed in some cases to make sure that it's adapted. But yeah, I'm happy to say that on the whole, it's not a conversation that is sort of here and now. It's something that we can sort of plan in long term, right? It's more of a long term issue.
And Oliver, from your point of view?
Yeah, I think, as I touched on previously, I think the benefit with the battery supply chain is that the supply growth that's required. I think, a lot of this sustainability sort of issues or sort of some of this mitigation can be built into these projects from the beginning, and we're seeing producers with a lot of focus on this area, and I think that really helps to future-proof a lot of these assets and hopefully reduce the risk from this standpoint. I think maybe within nickel there are a few sort of legacy assets that either rely on large amounts of coal-fired power, even on sort of on-site coal-fired power stations, and there you're seeing some shift to renewables. So I think that in certain aspects of the supply chain there is some risk for sort of partial write-downs and loss of value, but I think in general, it should be one that they can take on and build into these projects from the start.
Okay, perfect. And probably to take a different angle, Elsa, how can commodity and I would say especially energy and mining companies effectively influence and reduce indirect emissions?
Yes, I think for a commodity trading company, we have to manage those famous Scope 3 emissions, and those famous Scope 3 emissions cover a lot of different things. Obviously, we have the emissions that come from upstream, from the production of the product. We have the emissions that come from the transport, and then we have the emissions that come from the actual use of the product, which is approximately 70 to 80% of the emissions when we talk about oil and when we talk about gas. And as a middleman, as a trading company, what can you do to actually change those? There are some levers on the upstream side and on the transport side. The good news is that more and more we have access to information on the matter. So transparency is improving. We are able to estimate the amount of CO2 that has been emitted on all the tons of crude or cubic meters of gas that we transport, as long as we know where it comes from. So we can start really making choices around this. But at the end of the day, we can choose to not buy some of the products that are too carbon intensive. That doesn't mean that somebody else is not going to buy it. So are we really making a difference? That's the conversation we need to have. What we can also do is take an approach that would be similar to an approach that is advised in the United Nations Guiding Principles on Human Rights in Business. Just focus on where you can make a difference, where you can have an influence as your company. So if you're the big one, if having trade with you makes a difference, then you can influence the way things are produced on site. And I think that's really the way, that's the way forward for a company that is mainly a trader, but still has some influence and local assets. Then there's the transportation, the shipping. Obviously, today the technologies are not exactly available to go to zero emission. We can improve the efficiency of our transport. Slow steaming is a really good example. And as a trader, we do have the choice of accepting that slow steaming, making sure it can happen, being ready to get the product exactly on time so that it could be slow steamed and then reduce the carbon intensity of the training. And then there is the downstream emission. Obviously, all those products are being used, and those are the main emissions coming from the commodities related to oil and gas. And this is switching our portfolios towards cleaner energy and making sure that the transition is being carried out. As what I was saying previously, I mean, we can commoditize product and we can play a role on the extension of different energy sources, and more we will have to make a move on those portfolios.
This is very refreshing to see the approach that you are taking. And probably until now we focused around the risks, but when there is risk, there is also opportunity. So, Justin, are there any opportunities arising from climate change for farmers and the coffee supply chain?
Yes, we think there are. There are about 25 million coffee farming households estimated around the world, maybe 125 million people involved in the coffee value chain globally. And the truth is that, while consumers are rushing towards a pattern of consumption with a lower carbon footprint, and farmers are kind of juggling how to adapt to climate change under more and more pressure, is we're going to need farmers more than ever to meet carbon emission targets, right? So all the big global brands in the last 6 to 12 months have made very bold commitments on having zero carbon emission targets or reducing their targets by a certain percentage. And this can only happen actually if we engage with farmers, because I guess maybe not all parts of agriculture, but certainly coffee, the biggest emissions are happening typically at farm level. So it's soil management strategies and what have you. So unless we have this engagement with farmers, we're not going to be able to change. We're not going to be able to help companies meet their target emissions targets. We're not going to change behavior. So I want to think that we're going to gradually shift from a sort of commoditized trade to really rewarding farmers for environmental services. We're going to be paying for a method of production that meets certain environmental goals, for instance, right? So this could be as simple as paying farmers, helping farmers to earn carbon credits for planting trees on their land, or some such form of negotiation. So I think there are opportunities. That it's not clear cut. It's not entirely certain how we're going to get there. But without engaging with farmers, without incentivizing farmers to have more environmentally friendly types of production, we're never going to meet these carbon emissions targets. So we see already in the conversations that are starting to take place in our sector, in our trade, that there's a willingness to discuss these things, right? In the past, we focused on standards and we started talking more about living income. Now we're talking about living income bundled with some kind of environmental service payment. So I think there are encouraging signs. We certainly as a company are positioning ourselves to make sure that we can get ready for this. So looking at, what kind of activities we can carry out at farm level, whether it's tree planting, whether it's looking at particular farming strategies that allow you to sequester more carbon in the soil. I think all of these things can be particularly helpful to the discussion, and of course they will need to be paid for, right? So I have some hope that farmers will receive incentives to farm in a better way. I think a second benefit potentially is we may see that actually some of the more smallholder supply chains that are oftentimes more delicate and operate under much more pressure could be favored in terms of larger industrialized models, right? Because at the moment, certainly the indications are that the carbon emissions from large industrialized farming tend to exceed emissions from smaller farming models, at least in coffee. So this gives me some hope that perhaps we'll have more support from the industry for, the smallholder sector and really the sort of more vulnerable members of the farming community. But time will tell.
This is very encouraging, I have to say. Oliver, moving back into the metals industry, the negative concerns about battery metals are, I think, apparent to everyone. But are there any positives that could develop?
Yeah, so I guess talking about the battery supply chain so far, I haven't mentioned Cobalt, which for many of the sort of downstream players within the battery industry is considered sort of the bogeyman within the metal space. Its role within the battery is quite critical. It's a stabilizing element, so sort of enhances the safety of these batteries and stop them catching fire in many instances. But the issue with Cobalt is that 70% of supply comes from the DRC. And really the downstream players hate that the supply risk from geopolitical, but also sort of a human rights standpoint that this presents. And as a result, they're trying to engineer as much of the cobalt out of the battery as possible, or they're looking for alternative supplies outside of the DRC, which in the volumes they require just don't really exist. But I think this is tragic in many ways. A significant portion of DRC cobalt comes from artisanal and small-scale miners. And yes, this brings with it huge risk associated with those human rights concerns and the child labor implications. And the OEMs don't like that because it can make them look bad. But this is an industry that supports millions of people in the DRC, and properly managed or better managed and regulated, it can provide huge assistance in helping people in the country start up businesses, upskill and add real value to the DRC sort of economy. So with all the sort of negative impacts of the battery supply chain, I think any potential positives really do need to be nurtured. But unfortunately, what we're seeing in many instances is companies sort of running in the opposite direction and just trying to sort of ignore the problem.
So let's hope that the trend will inverse as soon as possible. We're now approaching towards the end of the event, but I would nevertheless like to run another small mini panel as we did before. So I would ask the speakers to contribute their insights very briefly on what you believe are the realistic timeframes for real transactions into the zero carbon economy. So what do you believe that can happen compared to what has been promised today?
I'm happy to jump in there. Yeah, so I think sort of the issue with the mining industry is it's very energy intensive. And I think that presents some real challenges when it comes to hitting a sort of a zero carbon target. So what I'd say within our work, and you see that there's a lot of easy wins when looking at the value chain and helping to reduce those CO2 sort of emissions. And in some instances, you're looking at the processing side, just switching from coal to natural gas can deliver quite significant reductions in CO2 intensity. And yes, it's not zero, but yeah, I think there's real potential, and we are starting to see this with people looking at that and saying, okay, it's maybe not the cheapest way, but it will have at least minimize our environmental impact.
Any other take from the other speakers?
I can just say very quickly, I think in coffee particularly, I think there are some quick wins that are obtainable through technology and capital investment, particularly in the area of wastewater management. So the fermentation process of coffee releases a lot of methane, and that can be solved quite quickly. But I think for other long-term meaningful impacts, sort of order of magnitude 25 to 50% reductions in emissions, it's a 5 to 10 year process, because really you're looking at soil management change and planting of trees, if you're looking at an insetting strategy particularly. So I think a sort of 10-year horizon seems about fair for us.
And I would agree. I mean, I think there are really two different timescales. They are improving what we're doing, being more efficient, using the available sources of energy like gas that would actually reduce the impact, having better processes, etc., until 2030. And then we will have a shift to zero carbon solutions down the line. But those are still quite far away to be implemented in actual assets for the moment. So yeah, there is definitely two time frames there.
Thank you. And I think that this brings this virtual event to a close. Let me thank you for joining this webcast, and Elsa, Justin, and Oliver for sharing their insights. Thank you, and stay safe.
Thank
Thank you, guys.
Bye.